Everybody get up! And welcome back to the show this morning at 6:17. I'm your host, Lance Roberts. Michael Leibowitz joining us this morning. Good morning, Mike. How are you?
I'm doing great. How about you?
Well, I was just saying before the break, this is apparently we are now in the honey badger market because yesterday the president is impeached and the stock market goes, hey, that's worth a couple of points on the upside. So.
It's a QE market. I mean, this is what we saw QE, especially 2 and 3. Yeah. When the market, QE1 was a little different because the economy and market needed desperate help. QE 2 and 3 were done when the economy was a little slowing, when there were some slighter issues, and the market just rose. That's what it did every day. Didn't mean it jumped 30, 40 points a day, but you know, you'd have these days where it's up 2-3 points, 4 or 5 days in a row, and you look back on a week and it's up 20 points.
Right.
And it happens week after week. And that's what it feels like now. That there's, there's still not a great explanation for why we have QE, and even less of an explanation for why QE versus just doing more of the repo, because this is, quote, a temporary problem. And if it's temporary, repo is a tool for that, not QE.
Right.
And they can do 3-month repo, which is what they're buying in QE. So, it's a mystery, and it's one of many things out there that should be concerning, but is not because of the liquidity.
Well, and let's step this back real quick because we're throwing out some terms here, and there's some people that are driving to work this morning listening to the show on the radio. They haven't had their coffee yet. They're going like, what the hell are you talking about? And especially on a Thursday before Christmas. But the issue...
Sorry to beat it at Grinch.
I know, right? But there's an interesting thing. So, the repo operations, repo is short for repurchase operations. That's what that is. And basically this is, and we've explained this before on the show, but just a quick synopsis. All that's happening here is that somebody is going to the Federal Reserve. And I say somebody because normally it's banks, but there's other parties involved this time around, which may be major hedge funds. Going to the Federal Reserve saying, look, here is guaranteed collateral. I'm giving you a treasury or a government-backed mortgage, guaranteed payment, and I need you to loan me money overnight. And it's literally overnight loans that's happening here for companies to provide them liquidity to meet cash redemptions, obligations, whatever it is. This has gone way beyond what we've seen historically. The last time, and Mike did a great chart of this, and it's actually in our blog post that we put out earlier this week on Tuesday, that the last time that we saw repo operations, repurchase operations of this magnitude when the economy was not in a recession was in 1999. And during that process, the NASDAQ went up 100% over the 2 months. Now, the Federal Reserve started these repo operations in late 1999 because of the fear of Y2K. There was a big concern that all the computers were going to crash. There'd be no access to money. ATMs wouldn't work. Nobody'd be able to wire money anywhere. So the banks were basically stocking up on lots of liquidity, and the bank was supplying this going into the Y2K situation, but that didn't occur. And so when that money was pulled back out of the system, that's when we had the dot-com crash. The next time that we had a big spike in repo was right in the middle of the financial crisis. Obvious reasons there for the need of liquidity. And then now, and the repo operations now are more than twice the size as they were back in 1999, and yet there's no crisis on hand. We don't have a Y2K. We don't have a financial crisis going on. We've got this massive surge in repo, and there are rumors that it's major hedge funds like Citadel, Point72, others that are needing this liquidity, and their partner banks won't loan them the money.
Right. I mean, this has been going on now for 2 months that we've been unfortunately having to chase down. We're given excuses and we have to chase them down. So if you remember, the first excuse was that it was corporate tax day and that there was too much of a need for cash, and Treasury settlement was all occurring at the same time. Okay, it happens. Should have been planned for, forecasted. Those are easy forecastable numbers, but it happens. Well, it has only grown since then, and the excuses have changed. The latest, like you just said, Lance, is that the hedge funds, because the Treasury is issuing so much debt, the banks have been buying that debt, and the hedge funds have not gotten the funding they need.
Right.
So if that's true, and there's probably some truth to that, maybe another answer is that the hedge funds have to delever a little. Maybe they have too much debt on their books. But that's not the answer. The Fed wants them to continue, and this just looks more and more like 1999. And the economy in 1999 was doing really well, by the way.
Right. And so, and again, and also like 99, the markets were into the 10th year of their expansion, basically. We had the recession and kind of a really mild recession in 91. So by 99, we're heading into 10 years of growth, very much like we are now. So there's a lot of similarities. And we're not saying that this is 1999. We're not trying to make that comparison. All we're saying there's some similarities here to what we saw the last time this was going on, when the Fed was injecting this much liquidity without a crisis on its hands. And there was a perceived crisis of Y2K, but we don't even have that now. We just have simply a function that the economy's going and global growth is a little bit weak. But in the latest Fed meeting, they even kind of extracted that view that global growth was weak and under threat because the trade war's been removed.
Right. And the sad part is actually, I'd say we had a lot more going for us in 1999. Right. The government was running a surplus for a year or two right there. The economy was strong. Productivity was growing pretty rapidly. That was the birth of really the .com era, the internet. And now we got a government that's borrowing well beyond what it can. Consumers and corporations borrowing at record levels. Natural economic growth is way below what it was then. And you have much more Fed intervention, which may help the markets day to day, but it creates more instability. And whether it's 1999 or 1997 equivalent, we don't know. But we do know that valuations are approaching the levels of 1999 and are above those of anything we've ever seen, including 1929, the Great Depression. So, investors we're all stuck. Yeah, you have to participate. But what's so important, and I think what so few investors understand, is that you have to have your finger on the trigger, and you have to know when those signs are coming that it's time to lessen up a little, and to start hedging and to start getting out of stocks, even though the party's still going.
Yeah, it's interesting talking about 1999 and kind of just a coincidental moment in time. Bernie Ebbers. There's a name that people have long forgotten about, but this guy's been in jail. He was the CEO of WorldCom, orchestrated a $7 billion fraud, accounting fraud. $7 billion. Let's throw some numbers out here, right? Just $7 billion. Orchestrated a $7 billion accounting fraud with WorldCom, got 25 years in prison. Now, he served 13 years. Now, this guy's been in prison for 13 years. Now, he's blind. He's got diabetes. They're going to let him out for health reasons, let him, kind of go home and pass with his family. But it's interesting. This guy has served 13 years in prison for this accounting scandal back in 2000, yet not one CEO went to prison after the financial crisis. Not even the guy, not even Mozilla over there at Countrywide, who orchestrated probably the most egregious mortgage scandal on the planet. He didn't even go to jail.
And that's something else to note. Back then, corporate fraud was prosecuted. Now it's. I'm not saying what we have now is fraud, but it's not the truth. They report two set of earnings numbers,
right?
And everyone looks at the one that is the fraud. Not legal fraud, but it's
pretty close. I mean, when you look at some of the fudging that goes on with the accounting numbers that are reported as operating earnings, yeah.
And we've both written about this, the growing divergence between the real numbers and the fake numbers. And you throw in the share buybacks, and it's a scary environment, Lance.
Yeah. No, it absolutely is. But again, Bernie Ebbers set to be released over the next couple of weeks. So again, it's just crazy. I mean, you ask a lot of investors today who Bernie Ebbers was, and they have no idea. But they look back at the .com crash and they go, "Oh, well, it was just .com stocks blowing up." Well, no, it was Enron, it was WorldCom, it was Global Crossing, it was these major accounting scandals that were going on back in 2000 that led to Sarbanes-Oxley. But we had the same thing occur in the financial crisis, and yet nobody remembers. So.
And companies like Stamps.com, companies that no one has heard of today, but were big companies back then.
Absolutely.
Or market caps were big, at least.
Let's switch gears here a little bit. Let's talk about the year in review, so to speak. It's been a very interesting year. Going into 2018, the markets were surging in January of 2018 on the back of tax cuts and tax reform. And then we started this trade war. And we wound up having a 20% correction, roughly, almost 20, heading into December of last year. And this is when the Federal Reserve reversed course and they said, you know what, we're done hiking rates. And in fact, we're probably going to be cutting rates. And there's a potential that we're going to have to do, we're going to stop reducing our balance sheet and all these things. And it became a very bullish environment for stocks in 2019. Stocks are up about 28% this year so far. And as we look into the end of this year, here we are, the end of a decade, right? So this is the end of a decade-long cycle. The bull market has continued very strongly now for the last 10 years. And, here we are with this push higher, this 28% increase in stocks. Where does that potentially, in your mind, leave us as we head into 2020, starting the new decade for markets and money?
So earlier we were talking about 1999, and I mean, we definitely do it, but a lot of investors do it. They look back in history and try to figure out what periods of time are similar. And when you can find those similar time frames, you can compare and contrast and try to figure out if what happened then could happen now and plan accordingly. So one of the things you think about in 2018, January of 2018 was unbelievable before the market started selling off. I believe it was like in 25th, somewhere between the 20th and 25th of January, it started selling off. But prior to that, the market was just every day up 5 or 10 points without, there was probably, I'm not looking at a graph, but I'm guessing there were less than 4 down days in those first 20 days or so.
Yep.
Probably even less than that. And it was just going up every day, and everyone said, okay, here it comes. Here's the blow-off rally. And we're, like we saw in 1999, this thing can go up a lot more before the end of the road. And, the economy at the time was almost the longest expansion in history. It was about 6 months short. So here we are again. Now we have the longest economy expansion in history. And I get the feeling that January could be a just melt up higher to a point. What stops it? I don't know. There's a lot of potential news out there, but we also have figured out the trade deal with China. The impeachment process is likely gone now. It's out of the news.
Although I don't really think the impeachment really affected the markets ever. I don't think the market. I think the markets always assumed that the Democrats would impeach him, but the market's pretty much already factored in that that's where it dies.
No, I think that's right.
Yeah.
And it will die in the Senate most likely, and that will be that. So and Brexit will happen, but it's going to seems like it's going to happen on more friendlier terms than a hard Brexit, although that still is yet to be decided.
Right.
So there is a little bit less indecision, but as always, we don't know what's coming.
Well, it's interesting that you brought up trade war because, I went back and looked at the tariffs as an example. And yes, we have reduced tariffs somewhat, right? So we didn't add more tariffs. That was good. And we did reduce some of the tariffs, but if you actually look at the amount of tariffs that are still on goods, it's actually a pretty good amount of tariffs still exist. And of course, tariffs are a tax, and that does potentially impact exports to other countries, and exports make up about 40% of corporate profits. So, there's a big hope here that, China is going to make these massive purchases of $50 billion worth of agricultural products. The most that they've ever purchased is about $25 billion. So they're looking for a country to double the amount of purchases in a very short period of time, which doesn't really seem to be realistic. I think the risk to the markets next year is that because China has already set up agreements with Argentina and Brazil and other countries for some of the products that they need, that they wind up not meeting their obligation under the trade agreement to purchase the amount of goods that have been agreed to, at least in theory, and we potentially wind up back in a trade war again. And that could be something that might impact markets next year.
I agree. I mean, look, in general, the risk is the market is way ahead of itself. Mm-hmm. Not just over the last, kind of from a macro perspective, which we talk about a lot, but from a very shorter term perspective. Earnings haven't grown, and they've actually shrunk over the last year, and the market has zoomed forward. Mm-hmm. So the market has priced in a lot of growth that has yet to happen. So the point being is when you're that far ahead, you run the risk, you're over your skis. You run the risk that anything can trip up the market. It may be trade, it may be something with Trump, it may be who knows what. Things happen. They happen all the time. So, I think the point is to obviously pay attention to China, to pay attention to all the big ticket items that can occur, but realize that it doesn't, when you're this far from reality, mm-hmm. from any kind of historical norm, it doesn't take much to trip up the market. So you really have to pay attention to what's going on. And that's why the repo thing concerns us, because the charts, it is a big deal what's going on, and it's just being swept under the rug.
Well, so, and I think that's an important point, right? Because, we look at the amount of leveraged loans that are out there in the markets today, and we take a look at these covenant light loans that are out in the markets today. And we take a look at the amount of, triple B rated bonds that are on the verge of going into junk status, which would require pension funds, mutual funds, et cetera, to sell those bonds because they can't hold junk bonds in a lot of these funds. So it seems to me the biggest risk here, and this repo, if it's true, and again, we don't know who's actually needing this repo to such a great degree, but if it is a major hedge fund, let's remember, long-term capital management in 98 was about $100 million fund that the Fed had to bail out because they were afraid that the failure of long-term capital management would destroy the economy, and it was $100 million. We're talking about Citadel and Point72, which are $70 billion plus funds each.
Right. But the problem is the leverage.
Yeah.
So yes, long-term capital is $100 million, but I think they were using like 30 or 40 to 1 leverage, meaning that even though they only had $100 million in capital, they had billions of assets on their books. So when you're levered that much, it only takes a small percentage move in those assets to go against you to basically lose $100 million and put you out of business.
Right. Well, and that's what I'm saying here. Though, we're talking about sizes of funds that make long-term capital management look like a failure to start with. I mean,
exactly.
And these things are so huge.
Right. And where it is, there's 3 or 4 of them that are heavily levered and heavily reliant on the repo markets to keep that leverage.
Right. And so my concern is that if we go back, my concern for 2020 as we go into that is not so much economic, not so much earnings related. It's the credit issue. There's a tremendous amount of credit leverage in the markets on a variety of fronts. A sharp move in interest rates for one reason or another. 10-year Treasury rates go to 3% or 4% for some reason. There's a sharp spike in inflationary pressures for some reason, and the Fed has to start hiking rates. There's a lot of things that could trip up this amount of debt in the markets, and a lot of it is very akin to the subprime mortgages that we saw back in 2008 that took the market down. But that was only $600 billion. We've got leverage loans of twice that amount in the markets. We've got $400 billion of these green bonds that have been issued for projects that are speculative in nature. There's a lot of risk built up in this market that is vulnerable to an interest rate shock that could occur from a variety of angles that nobody seems to be too concerned about. And I think that's the thing that keeps me up at night.
Right. In 2005, 6, 7, all we were told is that house prices don't go down. AIG's models were built on the fact that house prices don't go down. Well, guess what? They went down. Today, we're being told that there is no inflation. Inflation doesn't even exist anymore. The Fed can try to get inflation all they want. There's no such thing. Well, maybe the inflation boogeyman comes out of his cave after 30 years of hiding.
There you go. the general consensus is that 2020 will be another up year. The markets always predict the next year coming, whatever year it is always going to be an up year, right? In 1999, it was predicted that 2000 was going to be another boomer year for stocks, right? 2008 was going to be another boomer year for stocks coming out of 2007. The markets always predict that the markets are going to be up. All we're talking about, and again, when we talk about our portfolios and how we're invested right now, we know we're fully invested in the markets, but we are putting hedges in our portfolios. We are doing some things to help hedge some risk just in case the markets don't turn out as optimistically as a lot of Wall Street analysts currently expect. And there's a lot of things that kind of trip things up, and that's all that Mike and I are talking about here. What are the potential of things to change that outlook for?
But let me add to that.
Go ahead.
Let me add to that because I think it's important. Yes, we are fully invested. And we recognize that the market is likely to creep up higher. I mean, that's the way gravity has taken a market for now, and we have to go with the flow. Like Lance said, we are hedging our portfolio. We have slightly increased our exposure to the energy sector, to the value sector, to the deep value sector that is, in our opinion, underpriced. But importantly, we are monitoring events closely, and we are prepared to act because we know what we're seeing is not sustainable. Mm-hmm. So we have a plan of action in place, ready to go. We know what triggers that plan of action. We have stop losses. We have a bunch of risk measures in place so that when we're concerned that the market is going to give up these gains, we can limit our losses or, to some degree, even try to profit as the market goes down. And I think that's a big difference between what we're doing and a large majority of investors that are just, the river's just floating down, we'll go down with the river and everything will be good. Well, at some point that tide will turn and the current will switch on you. And that's where you have to have a plan in place and recognize levels that you constantly monitor to reverse your positions.
Well, and again, I think that's a very good point here because, the majority of individuals are told to just buy and hold investments, that you just put them in the markets and you just sit on them and, they go up over time. And, and we talked about this on the show a couple of weeks ago, Mike, that I was reading an article about this guy. He's 24 years old and, he's investing in the market and he's saving like crazy, and that if he just keeps getting 8% rates of return on his money for the next few years, he'll have $1 million in the bank. And and so you look at this, right? He's 24 years old. He was 14 when the bull market started, right? So there's so many people in the markets today that are giving advice to other people who have never been through a bear market. They just assume that what is, and this will continue indefinitely because there's no reason it shouldn't. It's gone up every year. Why won't it just keep doing that? And this is very akin to me. I remember back in going back to our 1999, scenario here where, you and I were alive and in the markets. And we remember we were reading stories about where the Dallas morning newspaper got a cow. And they drew a grid on the out of tape on the parking lot, and they put the symbols of stocks inside the grid. And wherever the cow pooped, that was the stock that they bought for their portfolio. and the cow outperformed.
Only in Texas.
Only in Texas. That is correct. And the cow outperformed Wall Street, right? But we saw so many of these things, right? Talking about people were getting tips from, their barbers, their grocery clerks. Everybody was day trading on, because of E-Trade had just really kind of come into full bloom. But it was this assumption that after such a long win streak in the market, it was easy, right? You just put money in the market and it just goes up every year.
Well, I think you see a
lot of that sentiment again today.
Well, but I think it's a little different and even more scary today. Back then, you still had to pick the right tech stock. Didn't mean it was a good tech stock, but you had to pick the right ones.
Right.
Because those stocks were outperforming the market by a lot, right?
Right.
You had to be in the right ones. Today, it's actually the opposite. Today, you have to be in either Apple and Microsoft or just the S&P 500.
Right.
It's passive versus it was active, and it's passive now.
Yeah.
So everyone is in the same boat today. Back then, when they started selling these big tech names, value stocks had a great year in 2001, 2002. Right. So there were places to hide and places to make money in the stock market. Today, everyone is on the boat. Everyone's on the same side of the boat, the same exact boat.
Yeah, they're all in the same, and they're all in the same boat, and they're all in the same two seats. The reason that Mike brought up Apple and Microsoft is because in 2019, the market is up 28% for the year. Of that rally, Apple and Microsoft made up almost 38% of the entire gain for the year, just those two stocks. The other 38% of the gain, so that's 76% of the entire gain of 28% for 2019 came from the top 15 stocks, the biggest stocks, right? So it's Microsoft, Apple, Netflix, Amazon, Google, right? So those top 15 made up 76% of the rally this year. The other 24% was everything else in the S&P 500. The other 485 stocks are the ones that made up just a very small percentage of the overall rally. So that's why Mike was bringing up, Microsoft and Apple, is because the rally is so confined to the top 15 stocks. That's the problem.
And it is leaving some companies, and we spent a lot of time looking into some of these companies that are left behind. That have been that whose graph looks the exact opposite of the market.
Exactly.
And we're looking for value. Our goal is to buy low, sell high, not to buy high and hope to God we can sell higher.
Well, that works, sometimes. It
does.
You can definitely do that. I'm not saying that's a bad strategy, but
does. It's nice having the insurance and the cushion of buying something very cheap.
Yeah, well, and
doesn't mean it can't go down either.
Right.
But you have more cushion.
This is true. But, that's Ben Graham's margin of safety, which is, if you do buy value, ultimately, there's, as Warren Buffett said, price is what you pay, value is what you get. And we tend to forget that in bull markets. If I go into a neighborhood and I pay $500,000 for a house and every other house in the neighborhood is only $250,000, it's very unlikely that I'm going to get $500,000 when I try to sell my house in the future, because the value of that house is ultimately going to be relative to every other house on the street. And valuation in the stock market is much the same way. At some point, if you overpay for the value of the stock of what you're getting, eventually the market is going to reprice assets to the value of the relative value of every other house in the neighborhood. And that's where investing mistakes are often found. And it's in that moment that investors make a huge number of mistakes, but primarily the one is, and the biggest mistake that investors make is, well, if I hold it, it will come back. But the problem is the time that you lose waiting to get back to even.
Right. Here's to put this into a little context. The market is up 28% this year, I believe.
Right.
Earnings are down on the year. The economy is growing, 2.5%.
Yep.
So the value of the companies has grown somewhere between 0 and 2.5%. Pick a number in aggregate.
Yep.
And the price of those earnings has risen 28%. So the question you have to ask yourself is, was it cheap before, and is the stock price catching up to where it was? And the answer is no, because they were expensive to begin with. So then the question is it sustainable? Can that $500,000 house go to $700,000 next year? All the while, all the other houses are $250,000. So maybe it can, but the odds are increasingly working against you.
Yeah, exactly. And as we kind of wrap up the show for the day, the thing that I want investors to focus on going into 2020 is that, yes, it is a presidential election year. Presidential election years tend to be positive for stocks. So it's certainly, what we're saying here is certainly it doesn't mean that we're not saying that stocks can't rise and the market can't rise in 2020, because you do have a presidential election cycle coming up. So there'll be lots of promises about, infrastructure spending programs. There's going to be lots of promises for more government spending. We just passed a $1.4 trillion spending bill. And if you take a look at the economic growth that we've had in 2019, it's primarily been driven by government spending. So more promises of more government spending will certainly help keep stock market bulls buoyant heading into the election. But if something turns out in the election that surprises the markets or changes dynamics of markets or a variety of other issues, that could really change the tenor of the market very quickly. So there's a good, and again, we go back to the China issue, we go back to, credit issues as well. There's a lot of things that could really impact the markets next year. And just because every presidential election year since 1945 has been positive, statistically speaking, if I flip a coin 100 times and I get heads every time, the odds are increasing that eventually I'm going to get a tail. And the point about that is that, yes, every presidential election year since 1945 has been positive. Statistically speaking, there's a much higher probability now that a negative year is not a small chance. There's an increasing chance that we could see a negative year in 2020 just because it's presidential election year. So don't necessarily put all your eggs in that basket. Pay attention to Mike's point, pay attention to the risk, pay attention to what's going on, and most importantly, have a plan. Having a plan to deal with risk is what helps you be a better investor over time. Mike, thank you so much. Merry Christmas to you. And be sure and get our latest articles. Mike wrote a great one yesterday about what we're not being told about the trade war. That's on the website now. And our new article out this morning about why the stock market is now just a club for the elite. That is all on the website now at realinvestmentadvice.com. Have a great Christmas. We're going to see you after Christmas, but have a great one. Enjoy. Merry Christmas to you. Merry Christmas to your family. And we will see you after that. Have a great day.
Back.